All right, let's be real for a second. Have you ever just stared at your charts and felt totally lost? You know the feeling. One trade goes up, the next one goes down, and it feels like there's no rhyme or reason to any of it. It's a super common frustration. But what if I told you there's a systematic way to start your day with a clear, data-driven idea of where the market wants to go? You know, it's that feeling of pure randomness that can really mess with a trader's head and their account. But the key to shifting from those coin flip trades to high probability setups, well, it all comes down to understanding something called daily bias. Now, this isn't about pulling out a crystal ball. It's about building a solid game plan for the day based on what the market has already shown us. It's about having a plan. And in this explainer, that's exactly what we're going to do. We're going to break down how to build that plan. We'll start with what daily bias even is, then walk through a super simple 3-step framework to find it. After that, we'll apply it to some real trades, talk about the crucial mindset you need, and then wrap it all up with the key takeaways. So first things first, before we can even think about entries or exits or risk to reward, we need a directional thesis. It's the most basic question. Are we generally looking for buys today, or are we looking for sells? That's the core question daily bias is here to answer. So what is daily bias, really? It's just our educated guess for the day's likely direction, and we form it by looking at what happened yesterday. You see, that single daily candle from yesterday tells a whole story about buying and selling pressure, and that story often spills right over into the next trading session. Look, it's a probability game, not a certainty, but man, it gives us a powerful edge. And here's probably the simplest way to get your initial read on things. I call it the 2-candle rule. Just think about the psychology behind it for a moment. If yesterday's candle closed decisively above the one before it, what does that tell you? It shows strong conviction from buyers right up until the market closed. That momentum often carries through. On the flip side, if it closed below or got sharply smacked down from a high, it's a huge signal that sellers just took over. That pressure is now the dominant force. This right here is our starting point. Okay, so we've got our first clue from the 2-candle rule. But to build a really solid trade idea, we need a process we can repeat every single day. That's where this 3-step framework comes into play. It's designed to take you from that big picture idea all the way down to a specific actionable plan. These are the 3 pillars, and they're super simple: direction, location, and confirmation. We start out macro with direction on the daily chart. Then we zoom into a specific location where we're expecting a reaction, and finally we get micro and wait for that confirmation on a lower time frame before we put any of our money on the line. Let's break each one down. Step 1 is all about getting the context. We're on the daily chart and we're just looking back over the last month or two. You don't need to go back a whole year. Honestly, the last 20 to 40 candles give you the most relevant picture of what's happening right now. What's the story the market is telling us? And that story is usually going to fall into one of 3 categories. Is the market in a clear uptrend? You know, making that classic staircase of higher highs and higher lows? If so, our bias is naturally bullish. Or is it in a downtrend with lower lows and lower highs? Well, then our bias is bearish. Or is it just kind of stuck, chopping sideways in a range? And this brings us to one of the hardest but most important rules in trading. If there's no clear trend, if the market is just messy and range-bound, then the highest probability trade is often no trade at all. We are not here to predict what might happen. We are here to react to what is happening. Seriously, learning to just sit on your hands and preserve your capital in choppy markets is a skill in and of itself. All right, so let's say we have our direction. It's bullish. But that doesn't mean we just hit the buy button anywhere. Now we move to step 2. We've got to find the specific location on our map, that high probability zone where we actually want to do business. These are the landmarks we're hunting for. The previous day's high and low, huge magnets for price. Major swing points are also critical. And then there are fair value gaps, or FVGs. All an FVG is an area where price shot up or down really fast, leaving an imbalance behind. The market loves to come back and revisit these gaps to sort of rebalance the price. So why these spots? Because that's where the liquidity is. That's where all the buy and sell orders are stacked up. And that's where the big institutions are likely making their moves. And finally, step 3. We've got our direction, we've got our location. Now we wait. This is where patience really pays off. We drop down to a lower time frame, say the 15-minute or the 5-minute chart, and we just watch. We watch how price acts when it gets to our level.
We're literally waiting for the market to show its hand and prove our idea right before we even think about clicking a button.
Now, theory is one thing, but seeing this stuff in action is what really makes it click. So let's walk through two real-world examples, one bearish, one bullish, and see exactly how this three-step framework plays out on the charts. First up, we've got a bearish setup on GBP/USD. Our mission here is to find a high-probability spot to go short, to sell. Okay, let's break this down. Step 1, direction. Super simple. The daily chart shows yesterday closed bearish, so our bias is to the downside. Step 2, location. Now this is cool. Price pushes up and runs the stops that were sitting just above a recent high. We call this a liquidity sweep. It's a classic move to take out retail traders before the real move starts. That sweep is our key event. Step 3, confirmation. On the 1-minute chart, right after that sweep happens, price just aggressively smashes through a recent low. That's our market structure shift. It's a clear signal that sellers have taken control. The entry, on that little pullback right after the break. Boom. Okay, now let's flip the script and see how this works for a long trade. We're looking at a bullish setup on gold. This really shows how versatile this whole method is, no matter which way the market is heading. So what's the story here? Step 1, direction. The daily candle first dipped down and swept liquidity below a previous low, and then it reversed and closed with some serious bullish momentum. That's a powerful reversal signal right there. Our bias is bullish. Step 2, location. Price pulls back right into a key 15-minute point of interest we had marked out. That's our zone. Step 3, confirmation. Okay, on the 1-minute chart, after tapping our location, price creates what we call an inducement. It's like a small, tempting little dip designed to fake out sellers before it decisively breaks a high. That break is our confirmation that buyers are in charge, and we take the entry on the next pullback. Direction, location, confirmation. It just works. Look, having a great technical strategy is only half the battle, and that's not an exaggeration. If your mindset and your risk management aren't rock solid, even the best strategy in the world is gonna fail. It's absolutely crucial to understand that this framework has to be paired with some serious discipline. And these are the non-negotiables. Rule 1, always use a stop loss and place it where your idea is clearly wrong. Rule 2, react, don't predict. We wait for that step 3 confirmation trigger, period. Rule 3, patience is your superpower. If the conditions aren't perfect, you sit on the sidelines. Rule 4, stick to the plan. No emotional, impulsive trades that aren't part of your system. And finally, number 5, know when to just stand aside. In those messy, choppy markets, your job isn't to make money, it's to not lose money. Whew, we've covered a lot of ground, huh? From high-level theory all the way down to a 1-minute chart entry. So let's just boil it all down to the core message I want you to walk away with. If you remember anything from this, remember this. 1, find your direction on the daily chart. 2, identify a key location, like the previous day's high or low, and just watch it. And 3, wait for confirmation. Wait for that market structure shift on a lower time frame before you even think about entering. Direction, location, confirmation. That's it. It's a simple, robust, and repeatable process. Now, this framework is a fantastic tool, but it's one of many out there. Every successful trader eventually develops their own little twists and techniques. So I want to leave you with a question. How do you figure out your daily bias? What are the key things you look for that you absolutely won't trade without? Drop your thoughts and your strategies in the comments below. Let's all learn from each other.